Yeah.
And let's be honest here. In the course of the last couple of years, it's not like it's been smooth sailing, right?
Yeah.
You know what the S&P is up this year. You know what it was up last year.
Yeah.
It's been both years have been pretty good,
Yeah.
but it hasn't been smooth, right?
No.
And the biggest issue that we all forget about, not ever talk about it anymore, is at the beginning of last year, the crisis in all these regional banks, right, where they started
Right.
having problems because of rising interest rates.
Yeah. And that was
And
scary.
that
That
was
was a scary
scary.
time. We're getting lots of calls
Yeah.
about that, right? Yeah.
And we're having issues with other companies that are running out of liquidity. They may be running out of money for funding. Some of these private equity companies,
Right.
some of these EV startups are having some problems. You got a lot of these AI companies. AI companies need a lot of money to get their business going. But this vast pool of liquidity is still really present, and no one talks about that much.
Hello, Apriem family, and welcome to episode 21 of Apriem Financial Cents. We are 1 month into Q4 of 2024, about a week away from the election, and I sit down with Benjamin Lau, our Chief Investment Officer here at Apriem Advisors. We talk a little bit about interest rates, politics, corporate earnings, and really just kind of general expectations as we roll into the end of the year here in 2024. If you haven't done so already, we would encourage you to please subscribe to the channel, like the video. It really helps us out a lot. And other than that, just enjoy the episode. A lot's happened. So do you want to bring us up to speed, talk a little bit about Q3 2024, and then we'll kind of finish up and we can talk about maybe what we're seeing as we move into like really the end of the year here. Elections, just about 2 weeks away.
Yeah, it's getting very close now, isn't it, Josh?
Getting very, very close. And I feel like everyone's talking about it. So we talk a little bit about that. But let's finish out last quarter a little bit. How'd everything end up?
So last quarter was a crazy quarter, right? I think last quarter was really the culmination of a lot of things we've been talking about for the last 12 months. We've been expecting it and waiting for it, and it finally happened in Q3. A few months ago. And so the biggest thing for us was the Fed.
Right.
We've been waiting for the Fed for almost a year now to cut interest rates, right?
Yeah.
And the expectation was for the Fed to cut dramatically at the beginning of the year. They didn't.
Never happened.
They never happened. The economy was relatively strong. Surprisingly, it surprised all of us, I think. So the Fed didn't need to cut interest rates, and inflation stayed high. And I think over the first 6 months of the year, we saw clearly that inflation started to cool down and cool down and cool down. And finally, it did seem like in Q3 that inflation was cool enough where the Fed said, yeah, it's time. And that was a big moment. I think that was probably the biggest moment that I took away from Q3, was that the Fed finally cut rates after about a year waiting.
Yeah, I think, I can remember right at the end of, in fact, it was like November 1st last year, right? And all of a sudden the market turned on a dime because there was all this expectations that we were going to start to get cuts right at the end of the year. And then it was like, oh no, it's probably going to happen come March. And it dragged on a lot longer than expected.
Yeah, I mean, like that's a great point though. Right? About a year ago, we were thinking, or the market, I guess, not us, but the market was predicting what, 5, 6, 7, maybe even 8 rate cuts in 2024. Right. So far we've gotten 1, right? And it was a big one. 50 basis points was a big one. I won't give you that.
Sure.
But yeah, it's been a long time waiting. I think that does go to show you how strong the U.S. specifically, the specific U.S. economy was, and what a problem the Fed had getting that inflation lowered back to a more normalized 2% level that they wanted, right?
Yeah.
And so this is a big contrast to the rest of the world. The U.S. continues to be the fastest growing economy in the world, especially of the major economies. You see almost every other country or region, the ECB, the Chinese, cut rates pretty dramatically because their economies are so weak. But the Fed could afford to wait until Q3 where they said, maybe we should cut interest rates to support the economy.
Right.
Yeah.
Right. Do you think, it seems like we're getting some kind of new information that's coming out. It sounds like GDP is actually doing even better than expected. Do you think that maybe constitutes some of the reason behind some of the recent pullback we've been seeing or the weakness in the market? Or do you think it's just typical this time of year?
I think it's everything. I think both, Josh. I think it's a typical of this kind of year. It's definitely typical as we head into the election. Right, where it's so close to election. Having this pre-election year jitters is probably quite normal. I know we'll get to that a little bit later, but yeah, it's a culmination of that. And I think the biggest thing was probably what you initially said, was that the Fed, after this recent rate cut, really saw a stronger economy. After they cut rates, we had some more readings about the economy saying that, oh, GDP for the third quarter might be a little bit stronger than expected. Oh, retail sales continues to be pretty strong. Consumers continue to be spending money out there, which is a huge factor for GDP, right? That's about the largest component. Consumer spending is the largest component in GDP. That came in so strong that now GDP revisions, or GDP estimates are going higher for the third quarter. So you're seeing that. That goes in line with, even as the Fed was cutting rates on the short end, you saw, as soon as the Fed cut rates on the short end, you saw longer term rates start rising, probably because we saw some positive signs of how strong the economy was. Right. Okay. So that's why you see the longer rates, 5-year, 10-year, 30-year rates are going up, because like, wow, the economy is actually not that weak. We're actually doing pretty good there. And so rates ended up higher.
So is that essentially showing almost like an outflow of assets from longer duration bonds flowing more towards the market, because it's essentially showing that there's strength left in the market?
You see the money definitely coming out of the long-term bond market. Where it's going, I don't know quite yet, right? Okay. I don't know if it's really going into stocks or other risk assets. It does seem like it's going from the longer term end of the longer term yields, 10-year, 30-year maturities, maybe going to more what we call the belly of the curve, more towards the 3 to 5 maturities. Okay. I haven't really seen anything that shows that a lot of the money is coming out of bonds into stocks quite yet. But I think that will happen. I do think that will probably happen before the end of the year.
What's kind of the thought process behind what? I mean, I get, shorter duration. Right now, at least, we've had higher yields in shorter duration, right? And then we've got longer duration, which makes sense as interest rates come down, right? We want to be in those longer durations so we can get some more appreciation, right? But what about in that belly of the curve? Like, why do we see money kind of flow there versus either going with that short duration for the high yield or the long duration for the the higher value that they could get out of it?
Right now, what we're seeing, because you're right, the premise is that what you said initially was that the short end rates are really high and the longer term rates are really low. And if you think as almost as a seesaw, right?
Right.
When that pattern reverses, the fulcrum or the belly of the curve, that fulcrum is really where it pivots, right? It goes from short to high. It seems like that belly of the curve, that 3 to 5 year range, seems like it's the most safest, where interest rates won't change as dramatically,
right,
as longer term rates would or as short term rates would. They've been pretty stable so far. You're seeing some demand there. And also, I think that 5 isn't that long, right? Investing in a 5-year bond, even if you're investing in a 5-year bond today and you don't have to worry about it, in a couple of years, you don't have a 5-year bond in a couple of years, right? In a couple of years from now, you have a 3-year bond, right? In 2 years from now. And so and that's called rolling down the curve, right? And so that impact has a lot to do with why I think it's a little safer on the front end of the curve. Okay. And you have still pretty good yields, pretty good coupons on that.
So to summarize, you're kind of getting a little bit of both, right? We're still maintaining higher yield, right? And we've got a better yield there. But as interest rates come down, we can still get some growth that's going to happen there, but it's not going to experience the same kind of volatility if, like what we're experiencing right now, where interest rates happen to be going up on the long end of the yield curve. And if you're sitting in those, 10, 20, 30 years, bonds and interest rates are going up, you're getting hit from a
principal standpoint.
Yeah, principal standpoint.
Yeah. So I think it's a lot safer. On the other side, you would argue that this, if rates completely go to zero again, like they did during COVID, they probably won't get that appreciation.
Right.
But I don't think that we're in that camp either, and so we're not too worried about that outcome.
What does that run rate look like right now? I mean, what are we thinking as far as where interest rates are going, over the next couple of years?
That's a tough one, Josh. This is the debate, right? And this is the concern that we've had, that not just us, that many people have had. About the economy and about the future path of inflation and unemployment, everything that the Fed wants to control. Let's be honest here. The Fed is cut rates last month when the market, the S&P 500, was about 4% from an all-time high, 5% from an all-time high. When you had real GDP growth north of 3%, which is quite high, unemployment at about 4.3%, which is quite low.
Still low.
Moving up, but quite low still.
Right.
So the economy was already at a pretty healthy spot, right? And so my consensus is that our thinking here is that there's 2 types of Fed rate cutting cycles. Number one, there's a crisis situation happening. We know those times, right? COVID, 2020, 2007, 2008, 2009, that went during the great financial crisis. Those are more emergency financial crisis that needed interest rates to come down dramatically. I don't think we're anywhere near that, given what I just said about how good the economy is and how good earnings are. So I think this is more of a fine tuning of Fed cycle right now.
Mm-hmm.
Do I think that they're going to cut rates more? Probably. Right now, just to put in some context, short-term rates went from about 5.5% to about 5% last month.
Sure.
If inflation gets back down to about 2%, which is not quite there yet, that would make real yields at about 3%, right? Yields
so if I'm getting a 5, right, but I'm getting hit with 2% inflation, I got a 3% delta.
Yeah.
Right.
That's still pretty high. Okay. If inflation gets down to 2%, I would have to argue real Fed funds should probably be close to the a 2% to 150 basis points to 200 basis points. So that would imply, if you did the backwards math, the Fed funds should probably be about 3.5% to 4% if inflation gets down that low. Right?
Okay.
And I think that, and to be honest, Josh, I think we're seeing issues that inflation is going to get down low. Prices are still expensive out there.
Right.
And this is the big rub. Right? Prices aren't going up as quickly.
Right.
But they're not coming down either.
No, they're still growing.
They're still growing.
Right. Yeah. Just because we hit a 3 or a 2.5% inflation rate doesn't mean it's going backwards. Like, we're not going back to where we were.
Yeah. And so I think inflation could be a little bit stickier than we all think. So I'm not predicting that the Fed is going to cut for the next 12 months or 18 months. I think it's going to be a very slow and gradual move for the Fed.
Yeah. Well, the economy's so strong they don't necessarily need to.
Yeah.
That kind of brings us into a little bit of discussion about earnings, right? So how are earnings going right now, and what are we kind of looking at in that space?
Well, this is the biggest thing for Apriem and for our clients and our portfolios, right? We pay a lot of attention to companies, how much profits, how much free cash flow they're making,
right?
And that's because we pay attention to that because we think that's the main driver of performance in these stocks over the long term, right?
Sure.
Over the short term, over the week or months, that's, the stock market is more of a voting machine, as they say.
Sure.
Over the long term, over a couple of years, the real driver of performance really is their financial performance, and it really is either profits or free cash flow growth. And right now, profits continue to go up. It is amazing condition that we're in with the economy, and that has been. We wrote about it at the end of last year. We wrote about it several times this year already. And it still shocks me how strong corporate profits continue to grow. Now, let's set the stage here first, okay? Because right now it's the earnings season for a lot of our companies, right? And so they're giving their results. If you have all their earnings per share, generally speaking, you're talking about, for the S&P 500, you're maybe talking about $200, $220 per share in earnings that the S&P 500 was generating on an annual basis. Right now, we're probably around 220 to 240. It's forecasted right now, as we write this, or as we talk about this, next year should be about 260 to 280.
Wow.
It is a continued strong environment, and that is pretty strong, and it is really almost re-accelerated as we start the second half of the year.
And a lot of this, a lot of this growth in earnings and profit, is it due to increased sales, or is a lot of that growth really due to the fact that they did all this cost cutting before, or is it maybe a little bit of both?
I think it's a little bit of both, but more the latter than the former, right? The revenues, and I get where a lot of our clients and investors are concerned, right?
Right.
But it's not. It's a huge revenue growth year. That's not like we're buying a ton of stuff every left and right, right?
Mm-hmm.
The revenue growth is not that high. It's about 4 or 5%. That's about average, or a little bit below our average. The real delta is the operating margin that we're talking about.
Yeah.
A lot of that expense cutting is really dropping all those incremental cash flows into the bottom line.
Okay. So we know earnings have done well. They're continuing to do well.
The economy continues to do well.
Right. The economy continues to do well. Clearly unemployment's still remaining low. Right. And yet we've got some of these rate cuts that have happened, and there's more that are likely to come, but it might be slower than what has continued to have been predicted because the economy is doing so well. Right. But what's kind of the typical expectations as time goes on with those rate cuts as they occur?
Well, that's why I kind of brought. I really do think that there is two types of rate cutting cycles, like I was saying earlier, right?
Right.
Is it an emergency rate cutting cycle, or something's going, like the house is on fire and you need to put out the fire?
Okay.
like we saw in 2008 and in 2020. No, I don't think that's the case.
Right.
That's our house view, and I still think that's truly, there's no crisis that we need to put out there. I don't see any sort of a credit crisis or liquidity crisis out there in the market. We're not seeing that across the board. Funding markets are wide open. Anyone that can borrow pretty easily at this point. So I don't see that issue. So I do put this in the latter camp, where I do think it's more of a normal just adjustment cycle for interest rates. They probably, Powell and his group probably went too high. They started too late. They went too high. Now that's why they probably need to bring it down and adjust it a little bit. If that's the case, then the stock market actually does do quite well in those kind of environments, right? You've had maybe 7 rate cutting cycles in the last 50 years. 2 of those 7 rate cutting cycles were kind of crisis issues, right?
Mm-hmm.
Again, 2001 with the tech wreck, 2007 with the great financial crisis.
Right.
But really, outside of that, almost every other time the market has been up a year later. The market has really taken lower interest rates and bid up stocks about a year and 2 years later, and that's been pretty healthy for the stock market.
So this is more of we're bringing rates down it's a healthy move for the economy. Yeah. And that's why it doesn't have to be super rapid, because there's not really anything wrong, right? It would actually it would be a bad thing if we saw rates coming down really fast.
Yes.
Right? Because that spells out that there's likely trouble.
Exactly.
Right? Kind of like maybe I was a little overweight. I went on a crazy heavy no carb diet for a while. Right? I got things kind of on track. And now I'm adding a little bit of carbs back into the diet, because you don't want to maintain like that for too long, right? Like, it's okay to have have a little bit in there, right? Yeah. So we're just kind of getting back to now a more healthy environment that we should be in, right?
I think so. But time will tell. I mean, this is how we see it as we tape this. As we said, 2 weeks before the election, a lot could happen in the next 2 weeks, the next 4 weeks, and it'll be interesting to see.
So speaking of the election, that's on. In just about every meeting I'm having right now, that comes up. It's on everybody's mind. So we've talked about this over the years, right? We've talked about this during previous elections. What happens? I mean, if one party wins over the other party, is the market going to drop? Right? Should I be fearful? Should I be taking my money out and getting conservative right now, even though economically speaking, things look fine?
Well, first off, Josh, before I answer that question, that's a tough one, right? I do have to say this. And I'm I love watching and reading about politics. I'm that kind of news junkie. This one's a crazy one, right? This was a really interesting presidential election cycle.
Right.
In my opinion, this is the first time, at least in my history, that you've really seen 2 incumbents run. Right. With former President Trump. Yeah. You kind of know what he was after the first term.
Right. Kind of know what you're going to get.
Kind of what you're going to get.
Yeah.
With Vice President Harris, she's been on the ticket with Biden. Yeah. She seems like she's going to continue the Biden momentum.
Right.
She's been kind of public about it and policies. And so she might say that she's going to be different in some areas here and there. But I do think that she's probably going to continue that policy trade. So it's like you get 2 incumbents. It's a really interesting dynamic that I didn't think we'd be in at this time.
Right.
That's important for me, because I think, number one, the market, the economy, earnings, everything we've been talking about, it's such a dynamic thing, right? And it's such a multifaceted, dynamic thing. It's very hard for it to be influenced by one thing or another, right? By one single thing.
Because there's just too many things.
There's too many things, too many factors, right? The economy is more than just interest rates. The economy is more than just oil prices. The economy is more than just unemployment. And it's more than just the person in the White House. But I think what the biggest issue for many investors is that they hate the unknown. And I think that's the biggest thing. And in this case, we kind of have 2 known two known candidates, right? That I think will maybe cause less uncertainty going forward. It is tough. I think both candidates have very compelling views on what they would do to help the American economy and the American families. But some are good, some are bad, and it'd be interesting to see what they can get through, right? We've been doing this for a while, Josh. It's hard to handicap what policies the president's going to go through while he's on the campaign trail.
Right.
Right. It's very rare that all the campaign promises he or she makes is going to actually make it through a Congress or through an executive action. Right.
Yeah.
At the end of the day, I still think there's a high probability that we will have a split Congress.
Right.
No matter who wins the White House.
And oftentimes, a lot of the promises being squeezed into a 4-year period of time is just unrealistic.
Exactly.
Right? We're going to do all of these things, and somehow we're going to make that happen in 4 years. It's very, very, very difficult to do.
That's a really important point, Josh.
Yeah.
Right? It's 4 years is a long time.
Yeah.
I think whatever the president's main agenda is going to be,
right,
will probably show itself in the first quarter of next year, within the first 100 days, right? In the first, between January 20th and April 20th,
right?
I think that's when you'll see really where their priorities are and what they can move on.
And so it's not so much that the market stops investing, right? Mm-hmm. It just invests differently based on who's in office.
Sometimes there can be other exogenous events that can affect it, right?
Right.
I don't think many people could have predicted what happened with Ukraine,
right,
and what happened with oil prices and commodity prices across the board, and how that affected Europe and parts of the world. So that's a big one.
Yeah.
Thankfully, though, because the economy and the market is so multifaceted, the things have actually done pretty well. The stock market has done pretty well, almost Republican or Democratic presidents.
Right.
I mean, I'm sure you see in this point, we talk about many stats that the economy has just done well during both terms.
Right.
There's actually only 2 terms I can think about in the past 50 years where the market was negative. One of them was Richard Nixon, and I think that had a lot to do with going up the gold standard to pay for the Vietnam War, right? And that was the whole Bretton Woods situation that we had in the 70s. I think that was a huge impact. The second one was George W. Bush, right? Mm-hmm. He took over after Clinton. We had a huge bull run after Clinton with the technology boom, and then George W. just had a rough term. Both his terms actually were quite poor for the stock market, and probably after that huge froth that we saw in the late 90s. Other than that, most presidents, Republicans,
right,
the markets have done well during Republicans. The markets have done well during Democrats. It's kind of
it's almost like the market itself doesn't really care.
The market is nonpartisan.
Yeah.
Right. The market is
right.
The one commonality that you've seen, though, no matter who is president,
sure,
is that you see almost in every term, the market has had a pretty severe drawdown. Right.
Right.
By far, the statistic is that during the term of the president, usually stocks go up, but there's usually been one pretty sharp correction during your term. And I'm talking about a correction not of 5 or 10%, kind of like this year. Like this year, we've had like an 8% correction,
right?
A baby one.
Yeah,
I'm talking about like a 20 or 25% correction during the president's term, and that's kind of wild.
But it's pretty normal for that to occur throughout the course of the year, and for the market itself to essentially recover afterwards and come back and still end the year positive.
Yes.
Am I right?
Yep, very so.
And in fact, I think that some of these charts actually show a lot of that, right?
Exactly. So the market is almost in every instance we've had a downturn, the market has recovered and made new highs.
Right.
And so, but that goes to show you also during every president there was some sort of crisis or event that happens, whether it's economic or geopolitical,
right?
Especially with some of these current events that we're seeing right now, especially around the world.
Yeah,
they're very dynamic, but the global economy now does sort of seem to change and adapt, right? I do think about the Ukraine situation a lot from a couple of years ago.
Sure.
How worried we were about natural gas prices, about grains, because so much of the grains are produced in Ukraine. But the economy did happen to adapt, right? We started making grains in other parts of the world. We started shipping natural gas from America over to Germany. So the market was pretty fluid and adapting. It adjusted pretty well. And thankfully, knock on wood, Europe didn't see a dramatic recession during that time frame. The U.S. didn't see any recession in that time frame, and we were able to chug on through.
Yeah. So as we talk about that, it kind of makes me think a little bit about what I've heard Chris Whitaker, who's one of our financial advisors, say, and he talks about how really there's just this giant tide of liquidity, right, or really money around the world, right, and as certain areas kind of like water, right, as certain areas there's a hole that comes, it fills in on its own and levels out, right, and so that tide itself, essentially just continues to lift and fill in. So we have a section like what's the word I'm looking for, an event, like what happened with Russia and Ukraine, and now all of a sudden there's this gap in the world supply of goods, right? Natural gas, and the rest of the world adapts. It fills in those holes and it brings it back up to those levels. It's pretty amazing how resilient not just the U.S. economy, but the world economy as a whole can be, right? Because it also represents opportunity, right? And that opportunity is something that we, as humans, will constantly, find and fill as time goes on. So anyway, just interesting thought. Go ahead.
That is a really salient point, right?
Yeah.
And let's be honest here. In the course of the last couple of years, it's not like it's been smooth sailing, right? I know. You know what the S&P is up this year. You know what it was up last year. It's been both years have been pretty good, but it hasn't been smooth, right?
No.
And the biggest issue that we all forget about, not ever talk about it anymore, is at the beginning of last year, the crisis in all these regional banks, right, where they started having problems because of rising interest rates.
Yeah. And that was scary.
That was a scary
time. We're getting lots of calls about that, right?
Yeah. And we're having issues with other companies that are running out of liquidity. They may be running out of money for funding. Some of these private equity companies, some of these EV startups are having some problems. You got a lot of these AI companies. AI companies need a lot of money to get their business going. But this vast pool of liquidity is still really present that no one talks about that much. Some of it's provided by the Fed and some of it's provided by the government, but it's really helping paper over or smooth over the regional bank crisis we saw last year. Some of the issues that we're seeing in auto loans and credit card loans that are becoming late. Some of these issues with some of these EV startups that can't raise money, right? And so this vast amount of liquidity is still really rampant. It's still really healthy and flowing out there. And I think that's a huge sign that we look at to make sure that these crises don't become major crises, right? Yeah. Small fires don't become big fires.
Rolling into the end of the year, it's almost over. What's your, what's your thoughts? At least as we kind of get through the end of the election, are we bullish, bearish?
We're quite optimistic for the rest of the year. We've been quite optimistic this whole year.
Right.
As you know, we thought that this earnings picture was really the key driver for what was going to happen, despite what it was going to happen with interest rates. That trend, I think, is continuing for the rest of the year. And I think there's a bit of also investor psyche or momentum that's happening with the market. Yeah. It is very, very, very rare. I can't even remember a single time when the market was up 10 months into the year and didn't finish positive, right? By the time the market is up about halfway through the year, it's probably going to finish higher through the second half of the year. Yeah. And I think that's going to continue that year.
Yeah, I think the investor confidence seems like it's really, really elevated.
It's really, really elevated. You also, as I said, you're also seeing some of the data behind that support that strong momentum. Earnings growth is strong. People still continue to spend. Unemployment is still healthy, which is why people continue to spend. So I think there's a pretty nice backdrop for a strong year-end rally. Valuations are getting a little bit high. I don't want to say everything's all rosy. There's some stocks out there, especially like some of the AI stocks, some of the AAA stocks are getting a little bit expensive. Right. That's fine. There's always pockets of overvalued and undervalued companies in the S&P 500. But I think all in all, things are pretty good. And you're starting to see what you haven't seen up until now is that more companies do better, right? When we talk about earnings is not just these magnificent technology stocks that they're leading the way.
Right.
But starting this quarter, you're starting to see other sectors do a lot better.
Right.
Bank stocks, energy stocks, consumer stocks do a lot better too. I think that's another healthy sign.
Yeah.
It's the economy is what we're calling broadening out and getting deeper. I think that's a great thing.
I think that's fantastic. It's giving us an opportunity to essentially say, hey, this year we've had a number of great companies and businesses that have done very, very well and run up. But as you're hitting those all-time highs, that doesn't necessarily mean, hey, let's go and hide in the woods and wait until everything melts down, but more of a, hey, why don't we start taking some profits and let's start, getting back to those good, healthy investor practices, diversifying out, right, exactly. and rebalancing into the rest of our portfolio.
Yeah, if you look, there's a lot of cheap companies out there that aren't these magnificent seven stocks,
right? But they're very well valued. The price tag is really, really attractive.
They're on sale, and and they're very attractive at this point.
Yeah.
So we're pretty optimistic. I think it's gonna. I think if this trend continues, right, it's hard to predict too far in the future.
Sure.
But I think most CFOs have a pretty clear guidance, 6 months, maybe a year ahead of time. And I think that's kind of where we're seeing now is pretty continued strength for the next year. But we'll see. We'll see if 2025 brings us another strong year.